Hey everyone, welcome back to the channel. Today we are diving into the latest FOMC meeting as well as the unpacking of it, like what it means to our economy, the inflation as well as the stock market. So because this is the one which is going to be a game changer, so let's get into it. The FOMC is nothing but your Federal Open Market Committee. So there was a meeting which confirmed that many of us been fearing about. The central banks are totally grappling towards some serious opposing forces. On one hand, we've got a slowing economy. There's a economical growth, which is like slowing down. On the other hand, we have a rising inflation risk. And this is going to be having a bigger impact because the tariff and the trade policy is like definitely going to be a messier on this. So the Fed has predictably held interest rates steady. But here's the kicker, because they've revised up this value in this 2025 GDP growth, forecasting down to 1.7 from the 2.1 value. While the core PC inflation has been revised to 2.8 from 2.5%. That's a clear shift in your stagflationary direction. We call that as stagflationary. So because your inflation is definitely going to be like stagnating up here. That's going to be like happening up here in this. During this press conference, the chairperson Jerome Powell has had a lot of things to say about this tariffs and uncertainty. He even downplayed the importance of the famous dot plot as a guide to the future rate cuts. But here's a twist, because Powell sounded surprisingly dovish about the market. He wasn't too worried about the inflation expectations and called the tariff-driven inflation transitory. That's the main thing to be like noted about. Fed's core PCE projections for 2026 and 27 remains unchanged, which suggests that they are sticking up to their inflation cooling down eventually. But still the growth has skid from the tariffs, like it's expected to linger with the next year's GDP, like it's going to be trimmed down even. It's going to be like almost around 1.8%. That's how it's going to be like happening around. There's another big announcement as well. The Fed is slowing down its quantitative tightening program. So they have lowered the treasury redemption cap from 25 billion a month to just 5 billion now. So that's been reduced again. So what does that impact towards? The balance sheet reduction could now end up in your Q1 2026 instead of Q3 2025. So that's a big deal for the market. So market is going to be like definitely going to be like fluctuating because of this balance sheet reduction. So after this meet yesterday, the US Treasury markets rallied with a bull steepening up the buyers and equities jumped over 1.1%. Even the dollar index DXY gained slightly. But that's the catch here, like emerging markets, including India, are now in a tricky spot. We are in a very critical or a crucial zone now. While the Feds are cautious about their optimism and they've got eased about some pressure, the emerging markets are likely to fail a push and pull dynamic, like how we are seeing it in the market these days. A weaker dollar could help us have higher global uncertainty, but it offsets all those gains, whatever we are planning for. For countries like India, this could mean even more flexibility in the rate settings. In fact, an April rate cut is like looking solid. Definitely, we are expected to have a rate cut in this coming April, with possibly another one later of the year during the September. So there are two rate cuts which are definitely expected in your Indian markets as well. But keep an eye on the global dynamics and the effects that is going to have on this. So that's definitely going to be a snowballing effect which is going to happen in this. This will play a huge role in how the central banks like the RBI will respond to this moving forward. So to see it in numbers, the Fed's latest forecast suggests that the real GDP growth is dipping from to 1.7% in 2025, while the core PC inflation is expected to hit 2.8%. The unemployment is projected to rise slightly, and the median federal fund rates are going to be like 3.9%. So that's how it's going to be happening. And the bottom line is stagflation is definitely going to happen, and Fed is really walking in a tightrope. But for now, they're not hitting the panic button yet. So markets are still going to be like how it is perceiving now or how it is like progressing now. Countries like India's are definitely going to be like facing up the fluctuations which are going to happening, the stagflations as we discussed now. So we could see how it is going to be like impacted as days moves on, as we see a rate cut in the coming April as well as later part of the year. So what do you think about this? Is this Fed understanding inflation risks, or are they trying to stay calm on this? Let me know your comments below. Don't forget to like, subscribe and hit that notification bell so that you don't miss out on any or more insights like this. Thanks for watching this video, and I'll see you in the next video.